Stock market weekly chart review for the week of October 3rd through October 7th. Let's start off looking at the sector makeup of the S&P 500 per Yahoo Finance. We see technology has gone down just a little bit in the weighting of the amount of stocks in the S&P 500. Still around 500 stocks, but less of them are technology. Where it was closer to 28%, now it's a little under 25%. And then we've got healthcare creeping up to 15, a little bit over 14, but slowly creeping up to 15. Financial services up just a little bit with a little less than 13%. Consumer cyclical, aka consumer discretionary, 11.19. And then we're also just going to take a look at real estate for the fun of it, even though it barely makes up any of those. And the way that we're going to be looking at these is via these different ETFs. So XLK represents XLK is a technology ETF. XLV is a healthcare ETF. XLY is a consumer discretionary ETF. XLF is a financial ETF. XLRE, you can probably guess it, RE, real estate. And right now we're looking at the S&P 500. We got a 2-year chart, so 2 years going this way. Each candle is representing 1 week of trading. With a quick view, we see that the S&P 500 has been moving down for going back to basically the beginning of this year, kind of the end of last year, started going in the sideways range and then started dipping down the beginning of this year. And now here we are testing that 200-day moving average on the weekly chart. With this week specifically really telling, because look at how high prices traded up here. Still, last week we closed below the 200-day moving average, but prices rallied up this week and just gave it all back. Sellers pushed this back. So here we are, still flirting right around that 200-day moving average. XLK technology, similar picture. Prices basically did the same thing. Traded as high as up here, but selling pushed this down. Even though it closed higher than it opened, producing a green candle, this is really a very bearish candle since prices really got pushed down. And healthcare, look at that, same picture. Although this time we're not as close to the 200-day moving average, even though prices did trade really high and get pressed down, and we're right in here in this kind of support area. So I'm guessing if this is going to break 120 or around the 120 range, let's say 115 to 120, somewhere in there. Maybe not 115. That's pretty low. What is this? What's the low here? Total trading low. You'll see it right there. Let's look at that. Not just where it closed, but so if we're breaking like 118.75, not just tipping down like this, right? That little wick there. If it really breaks and it's closing, consistently closing below, then we'll probably be testing these lower areas, where looking to the left, maybe around that 115 will be our next support. So really, yeah, this 120 to 115 can be this area of congestion. And then our next kind of place might get sticky is below the 200-day moving average, but maybe with everything being in a downward market, cross that 200-day moving average, maybe it will just crumble or be a nice controlled decline like it's been all year. With healthcare, we see that it's back here around August, June, that it was started closing below the 200-day moving average, rallied up and couldn't maintain it when it touched this, got close to this 50-day moving average, and now here we are back below these, back below the 200-day moving average for consumer discretionary. Financials, and you know, real similar picture as far as this candle traded all the way up here, came down, closed just above that 200-day moving average. You see back here was testing the 200-day, rallied up, couldn't maintain that rally. Now we're back here testing that 200-day moving average. Real estate is just been collapsing. Look at these big candles, all big. Doesn't really seem to be any slowing of momentum. Definitely below the 200-day moving average, and it just seems like it's going to get worse. Let's take a quick speed run through the same order, but looking at the same stocks on this Pro 2 chart, which is basically going to tell us the same picture, right? Whether it's red, yellow, or green doesn't have to do with opening and closing, has to do with how much money is flowing in or out, tracking by big institutional players. S&P 500, you see money's still flowing out. We got this is a weekly stochastic, so it's overall showing us a big trend. We see the big trend has just been down. It started kind of tightening up a little bit right here, but it's still a pretty wide gap, right? It's a very, very wide gap between these two, so it's indicating still a strong trend to the downside. And as far as technology, same thing. Money's just continuing to flow out. Now, tightening up a little bit here, although until they really cross like this, it's not saying much. And then cross and kind of go up like this. And one thing, really keep in mind, this is a lagging indicator. So I like looking at it at the on a big term, like a weekly, a long-term trend, because what's the current indicator? Prices right now. Last week, right? That's what prices were like, let's say on Monday of last week. And that's already old news. So this is reporting, giving us a visual clue of what the old news is. And the old news is a strong trend to the downside. Sometime, is it going to start reversing? Who knows? It can stay stuck below that for a while. Healthcare. Similar picture over here on healthcare. Money has been flowing out. Stochastic was going sideways for a little while, but now has really taken a decidedly turned down, and with a decent kind of spread between it. You know, whereas right here, look at that. It's kind of goofy, right? Right there, you can see it's kind of wishy-washy. Even here, you see it going up, but it wasn't as strong as this uptrend. So it's indicating that we potentially have a strong downtrend on our hands. And when we're seeing the same thing with all these stocks, what does it really tell us? We've got a strong downtrend on our hands. Same thing right here for that, what do you call it? Consumer discretionary. Financials, right? Different sector, same story. Real estate, different sector, same story. Look at that. And it's just continuing to be this wide gap down. So prediction for moving forward. This is a line chart of the S&P 500 going back to the max of whatever data Yahoo Finance has. Looks like it's about 1993. And each one of these different colored columns, those indicate 1 year. I'll see here around 2000, we started this bear market kind of towards the mid-end of 2000, all of 2001, all of 2002, and it really didn't start becoming a bull market again until the beginning of 2003. So you have a little bit over 2.5 years going down. Now over here, you had a quick drop, quick bear market, and it only lasted a couple months. I don't even know if it was a full couple months, but you figure this is 1 year right here, and you see it drop down, and it's like by less than halfway through the year, it's already rallying up. So for the most amount of the year in 2000, it was rallying up. 2020, sorry, with this drop at the beginning. What's the point of that? The point is we don't know how long this can last. But for what it looks like right now, we have this little channel drawn. Don't worry about these. I don't know how to get rid of them. I really just want these lines here. And we see roughly that this is kind of the top of the channel, and this is kind of the bottom part of the channel. And is it exact? Maybe not, but nonetheless, hopefully it'll give you the picture. And you can see that what has been going on is that the S&P drops down, and here kind of rallied up tiny bit, drop down, drop down. Now here it had a big rally, and it tests this top of the channel, but it can't maintain it, and it drops down significantly. Right? Tries to rally up, but not really doing it. Comes down here, sort of tests that bottom part of the channel, and rallies up. Has a little bit of volatility in here, but rallies up. Look at that. Rallies all the way up out here. Breaks out of that channel, but it's not able to maintain it. Starts dropping down. Tests that channel. Not doing it. Drops down. And so now we're here at this ball, or little round thing, whatever you want to call that. So overall, this is, in order to reverse this bear market, we got to get out of this channel. And I don't mean get out like this. I don't mean get out like this. I mean get out and stay out. So right now, we're like, I don't know, would you consider that halfway? It's kind of like halfway. Now, right here, it couldn't even make it to the top of that channel at this part where it dropped. Right here, it definitely couldn't make it, right? See where it was tried and it dropped right here. So we want to see how far is this going to make it up to the top of this channel, and if it does, then is it going to break out? Is it going to stay breaking out, or is it going to fail and go to the downside? If it fails and goes to the downside, we're potentially we're already past this low right here. So the next lows that we would be testing would probably be around here. That's at like the 150, excuse me, 350 type of area. And if it's not able to maintain that, the next place would probably be around this 330. So what's a prediction? My prediction is more to the downside. However, if the government via quasi agencies and not directly the government and all sorts of technical debating going on of is it the government or if it's not, I'm just lumping it all into the government. If the government starts doing things to prop up the market, maybe that can keep it from dropping. If they do enough, they could get it to do this again, but it would really, really take a lot. And at this moment, we don't really see the signs of that. And not to mention, we got a lot of just bad news. Nuclear war talk, Credit Suisse, bad stuff in Europe. There's like all this like just kind of negative news. Does that mean it couldn't go up? No, but it's just some heavy factors to the downside. So what I'm looking to do is see how far it's going to go up, which really has already been fizzling out. And is it going to start dropping again? So what you can do two things that I would recommend. Number one, paper trade. Paper trade, you can learn a lot. You won't lose any money, not real money, right? Make mistakes, learn. In a volatile market like this and sort of a tricky market, if you don't really know how to profit from the downside, play with some paper money, figure it out. The second thing, go to iofsuccess.com, download all 4 of these or as many of these as you want. You'll be on a daily, anytime the market's open daily. Email list, I guess about 6 days a week. You'll be getting something designed to help you. And future stuff that I'll be making, you're gonna get. Which one thing that I'm gonna be making, if you're a little like, I don't know about this paper trading stuff, I'm making something to help you just start paper trading. So that's my prediction. I think we're gonna see more, potentially more to the downside, unless we see some sort of government type of rigging. Everything seems pretty weak. And we're going into earnings season, so we'll see how earnings do. Maybe they'll do some rigging through the earnings. You guys have a fantastic day, and I'll talk to you later. Bye-bye.